Hello and welcome to the Investor's Guide to Asia, where we go in search of the best investment stories from across the region. I'm Stuart Rumble, Head of Investment Directing for Asia Pacific at Fidelity International.
And my name is Taosha Wang, multi-asset portfolio manager. On today's episode, we will be bringing you stories directly from our investment analyst and also hear from one portfolio manager about how these ideas make it into the portfolios.
In today's podcast, we're looking in depth at some of the research that goes on behind the scenes at a big asset manager like Fidelity and how the recommendations made by investment analysts get filtered, assessed, and ultimately used by fund managers. We'll hear investment ideas from 3 of Fidelity's analysts and then from one of our most experienced portfolio managers on where those ideas have taken him. And that portfolio manager is Dale Nicholls. Welcome, Dale.
Great to be with you guys.
Before we get into the research stories, we cannot really ignore what's happening in the market. There's been tremendous amount of volatility. Dale, maybe tell us a little bit about how you have navigated those ups and downs recently.
Yeah, volatility is really the word, both for the stocks and just for, the situation that changes daily. So obviously spending a lot of time to try to evaluate the sort of lasting effects. Obviously, we're trying to determine where things go, but in terms of the impact on economies, commodity prices, et cetera, and what the implications are for stocks, I think, one thing that's coming out of it for us, or at least for myself, is that, we're probably going to be living in a world with higher energy prices, regardless of how things play out. So, spending a lot of time thinking about the winners and losers on the back of that, but also thinking about second order effects. I think, probably coming out of this, energy security is going to be something probably governments around the world spend more time thinking about their energy mix and, probably accelerates moves towards areas like renewables. So thinking about, the companies that can benefit, from that potential change, as you probably know, we've been pretty bullish on areas like energy storage and that sort of thing. So I must say initial conclusions are that sort of, bolsters that whole story.
Some long-term themes there, and it's clearly not going to be the last time that we're discussing this, probably on the podcast as well in the weeks to come. But we're going to try and pivot now to some of the investment ideas that we're going to focus on today. But before we do that, Taosha, question for you. Did you see the robot kung fu at the Spring Festival in China?
Yes, Stuart, I definitely saw them, and they're very exciting to watch, both from a technological perspective and also from an investor perspective, on top of being quite entertaining. But the reality is that they are choreographed, and I think what's even more exciting from an investment perspective would be to see robots in real and spontaneous environments, either performing human interacting tasks or performing more productive jobs. And that is, I think, the promise of a technology and where it is headed.
So robotics is certainly one of the most talked about themes in China. We're aware of the policy support, aging population that's creating demand, and of course, the advances in AI. But while the long-term opportunity is clear, I think in the near term, it's still uncertain. Certainly things around the commercialization, reliability, and of course stock valuations as well. So the challenge for investors is not really just identifying the theme, it's about where and when to invest. And to help us with that, here is Hong Kong-based analyst Reggie Pan, who covers industrials, to talk about where the latest breakthroughs in Chinese robotics are.
Robots were barely moving a few years ago, but now you can easily see them standing up, walking, even running and dancing. Robots industry is seen as one of the growing pillar of broader industrial sector in China. We are not seeing the robots everywhere today because still we're waiting for the ChatGPT moment of robots. There isn't a killer use case for humanoid robots by now because although they are dancing, they're walking just like human, but they still cannot contribute to productivity at a reliable level. And also, if you go a step further, you want more intelligence from the robot to be able to see and think for themselves. So I think there are some low-hanging fruits for those robots to really work and contribute. For example, I think factory floors will be where we see the earliest batch of deployment of robots. For example, carrying boxes, pick things and place them in a certain area, or sorting stuff in the warehouse, so that I think within maybe a couple of years, robots can become useful in factories or warehouses. But when it comes to home, I think it's going to take maybe much longer because there's safety concerns when you have robots living together, working together with a human being. There are a lot of progresses of robotics technology in both China and the US. Both countries have different advantages. For example, in China, it has a more established supply chain that they can borrow from the electric vehicles. There's a bigger industrial base in China. You can test robots in all kinds of factories and warehouses. In the US, you do have very strong robot makers such as Tesla and so on. The US has an advantage in the intelligence side. They have more compute power ready for robot training. I'm excited about the robotics sector in China. I think we've seen a lot of progresses in the past few years in the hardware, in coordination between hardware and software, and also in the development of brain and the intelligence for robots. I think there is a certain trajectory of development for the industry ahead. And as investors, I think it's a great time to be positioned for that bright future of this technology.
That was Reggie Pan speaking to us from the Hong Kong studio. Dale, the obvious question there is that, robotics, automation, such strong structural demand, but also investors frequently worry about these things being a short-term hype. How do you distinguish the two?
Yeah, I mean, I think you've got to step back and, as you say, sort of think about, the long-term opportunity, the barriers to getting there, and sort of what the timeline looks like, really. So, it's that sort of, the basic analysis that we do, and sort of, really thinking about what's, factored into stock prices and what's not. With regard to, robotics, I agree with, a lot of the points, Reggie has made. I just think it's going to take some time. We're still relatively early in this process, but we know it's going to be, a sort of a really significant market. And there's going to be disappointments along the way. I tend to think this is going to be one of those markets where we tend to overestimate the short term and probably underestimate the long term. So it's about being positioned for that, thinking about risk reward.
Dale, I heard you talk about this taking time. There will be some disappointment on the way, and I think that sort of speaks to the uncertainty around the development of certainly things like general purpose humanoids. So where along the value chain are you finding the investable opportunities today?
You can't ignore the robotics companies themselves. So, we're spending a lot of time thinking about or trying to identify the winners and losers there. But as we've talked about, that's sort of very early stage. And there's a lot of players, and it's unclear, but I do think you need to have some positioning there. The area that I think is a safer bet in terms of market position and the security of the market position is in the supply chain, particularly in components, in the sense that a lot of these components already have established market share in industrial robots. So you have some sort of sense of, the competitive edge that companies have, the market position that they've achieved. And you can, I think, some of that advantage will translate into humanoids as well. Like I said, established companies, established track records, established market positions. So that's probably, where I'm placing more of the bets currently.
What about the earlier stage companies? I mean, surely in these, rapidly developing themes, there are companies that are much younger and potentially much more disruptive. And how do you look at them, given, lack of data, lack of historical valuation, etc.?
Yeah, these are the robotics companies themselves, and it's hard. But I think, we heard Reggie speaking earlier. I think you've got to give him credit here for the work that he's done, both in terms of breadth and depth. There's a lot of new companies. He's spending a lot of time meeting a lot of these companies. Most of them are private, and really sitting down with the management teams. The team in an early stage company is very important. So understanding the team, their technology approach, the sort of traction that they're getting, they're sort of the things that we really need to watch closely. And then the depth side, as we talked about, there's the hardware, but the brain is the big part. That's going to be, I think, probably a differentiator over the midterm. So understanding, the different technology approaches of companies and, just, again, spreading the net wide in terms of our research to try to identify what's going to be, the winning approach.
Building on Taosha's question a little bit more, obviously these companies in their early stage are not necessarily profitable at the moment. So how do you size a position and investment in your portfolios, Dale? And where are there companies maybe that you're avoiding at the moment in this space?
Generally, the earlier in a company's development there is, sort of, as this industry is, the wider the range of outcomes, and the wider a range of outcomes, the higher the risk. So generally for me, the higher risk, the higher the risk is, the smaller the position is. So these aren't really big positions for me. They are bigger in the supply chain, but for the robotics companies themselves, they're relatively small positions, and we'll sort of evaluate them as the industry develops.
Sort of switching gear a little bit, we're going to talk about small cap. Take China, for example. Chinese small caps are often overlooked, and there's a wide range of companies. And in recent years, the landscape of these companies have truly changed as well. Increasingly, there are more companies in the new economy sort of segment of the market, whether it's advanced manufacturing or biotech companies, providing a completely different set of growth drivers. Maybe we can hear from a Hong Kong-based analyst, Teddy Gao, about how the sector deserves more attention.
I think China small cap is a very interesting space in the sense that there are a lot of companies, but they are under-researched. I think as a fundamental investor, this gives us good opportunity in the sense that we can try to uncover those interesting names who are basically hidden champions. Historically, Chinese companies are known for the low-cost manufacturing. However, we are seeing that they are now moving up supply chain and now provide high-value components. I think this also reflects that overall China is shifting towards a high-end manufacturing. Interestingly, if we look at some small-cap companies, they actually play a key role in the global development in the emerging industries such as data centers, smart glasses, and satellite communications. On the consumer side, we are also seeing that the Chinese companies are making their name globally. Historically, the Chinese companies are known for the white label goods, which are based on value for money. However, we are seeing that in some niche categories, the small Chinese companies are actually defining those categories, such as the consumer wearables and also the small home appliances. Drilling down into that, the innovative features and the fast iterations are basically the edge of the small Chinese companies to make their name globally in a very quick manner.
I think many of our listeners and viewers will be familiar that smaller companies often get associated with higher risk. But Teddy rightly pointed out that there are hidden champions, which means also higher return potential. Where do you see the market consistently underestimating smaller companies, Dale? Would you agree with Teddy's assessment?
Yeah, absolutely. There's definitely large parts of the market that are kind of ignored, and with smaller companies, there's less information. With less information, there's more mispricing, and I think that's why it's such an exciting part of the market. It is extra work. There's work to find these companies, but also stay on top of them, as we talked about. Generally earlier stage companies, you can have things change more quickly. There's a wider range of outcomes, so it's important to stay on top of the stories. In terms of the sectors, someone like Teddy covers pretty much everything, so he'll go to where the opportunities are. We can talk about some of those, but as he kind of touched on, I think, this applies to China in general, but I think there's a lot of sectors in the industrial space where people, I think, still underestimate the competitiveness of Chinese companies. There's a few factors behind that. Many companies have invested significantly in R&D over many years. And of course, we know the size of China's manufacturing base. So there's, we're talking about big markets, so there's real scale opportunities as well. So, a lot of the industrial areas are the areas where, we find a lot of opportunity, where the competitiveness of the companies is just underestimated. And, the fruits of that R&D spend over many years is starting to really show up in market share and pricing power.
I guess we've talked a little bit about the importance of scale, R&D. I'm assuming that comes and needs a lot of resource, and often you associate that with larger companies. Maybe you can be a bit more specific when you see the opportunities in smaller companies. Where maybe in industrials would you go and say, yes, I like the look of the smaller company versus a larger company in the same sector as an example?
I'd sort of point to, areas like, precision components, whether it's going into aerospace, guys that are doing some of the components going into areas like data centers and things like that. So real growth areas. Some of these markets are currently relatively small but growing fast. So you can see a path for these companies, to be just much bigger over time. Teddy talked of an area like smart glasses. That's still a relatively small market, but there's a lot of really strong competitors and sort of emerging players in that area that have strong market positions and strong technology that they're supplying globally. So it's actually pretty broad across really a range of sectors.
It feels like the opportunity set is almost infinite. I'm just really curious. Do you tend to find ideas and get your analysts to look at it, or does Teddy come? Like, how does it work?
It's a combination. So we're all have our antennas out, sort of looking for ideas. I think for any industry opportunity, that we're looking at, we're always trying to, I guess, map the industry. So really understanding who the key players are, who the winners and losers are, and why, who has competitive edge, and again, why, and how that's changing. So, as part of that process, part of building that map, you find new players on the map that are doing interesting things. And so, a lot of ideas come from that process of being in company. It's a pretty important source of ideas. So it comes from really both sides, where we're in constant communication around ideas. For someone who's completely focused on small caps like Teddy, his job is a combination of staying on top of the things that we own, but also his remit is also to be turning over a lot of rocks, looking for new opportunities as well.
I've heard you say in the past, Dale, that you can have fast-growing companies, but you need a pathway to scale. What gives you the confidence once you've met those companies that a company would go from small and larger rather than staying just as a niche player?
It's really a combination of factors. One is, obviously the market itself. So seeing, the long-term potential, just thinking about how a company's positioned, what we know about the sector, how big that can develop. And the second factor is, we kind of touched on it, but that competitive edge that they have. What moat does the company have? And how sustainable is that? Obviously we're looking at the big players, looking at how they could potentially disrupt, these companies, but it's getting confidence around that competitive edge. And that's why we're meeting with companies, constantly. You touched on it as well, but management is a key factor as well. So you can have the opportunity, you can have a great business, but you need a management team that sees that opportunity, has a strategy to really go after the opportunity, but then execute. And that's, again, why we're meeting with the companies often, to make sure they're on track and sort of executing on that opportunity. And, there's an element of track record that builds conviction as well, as, management teams that are doing what they say, I think, does help build that conviction over time.
So if robotics is all about investing under uncertainty, small caps presents a different challenge. As we've heard, it's about identifying those companies that can really build a scale and competitive advantages and grow over time. Here, the edge is clearly coming from deep on-the-ground research, meeting companies, meeting management, and understanding those competitive advantages and long-term return potential. Our final example brings in a different dimension where the opportunity is well understood, but the picture is clouded very much by geopolitics and challenges around the supply chain. Here's a mining expert at Fidelity, Sam Hithersay, on why markets are underestimating the world's reliance on China for rare earth magnets.
Rare earths. They are critical for EVs, renewables, and defence. But China control most of the market, and they've been exercising this control by restricting exports to the US in response to tariffs. Now we're in a position where Western governments are trying to build out ex-China rare earth supply chains. But it's a significant challenge, and we think the market might be underestimating this challenge, not just its scale, but the complexities of rare earths themselves and the choke point that is still China. China has spent decades consolidating the rare earth market. It controls 60% of rare earth mining. It has half the world's mineral resources and reserves, but it's truly dominant further downstream, where it refines 90% of the world's rare earths and manufactures 94% of the world's rare earth magnets. Now, we've always known about this supplier concentration and the risk that it poses to global demand. But it's only recently, in the last year, that that risk has really materialised. So now Western governments are scrambling to incentivise new supply by guaranteeing price floors, by taking direct equity stakes in rare earth companies. But will it be enough, and will it be fast enough, are the key questions that we're grappling with. We recognise that China's dominance didn't happen overnight, and it will take quite a period of time before Western governments are able to set up fully integrated supply chains, because there's no point in generating a mine if there are no downstream customers to refine it and to ultimately buy it for magnet making. We therefore think that this provides a natural advantage to the incumbents that are already producing, that are already refining, and that already have entrenched customer relationships further downstream.
That was Sam Heddersay speaking to us from our Australia office. Dale, the importance of rare earths is very well understood, but what is the market still missing when they try to price these assets?
Yeah, I would say it's becoming more well understood. As Sam sort of hinted there, I think it's really, actions of, really the last 12 to 24 months that have sort of, brought, the focus home here and in terms of the importance of these critical materials. They really are critical. Governments are clearly starting to take action, and I think you'll see more of those actions to come. Maybe what wasn't stated there as well, and part of the reason that I think the space is still very interesting is just the basic supply demand dynamics. Those still look very, very positive, and there are the types of challenges that Sam talked about on the supply side. So the underlying supply demand balance, which is obviously key to any sort of cyclical investment, I still think looks very positive. So combine that with government support that's likely to increase. We heard about price floors. I think on the funding side, you're going to see more action there. So as Sam mentioned, it's a good environment for the incumbents, but I'm also focused on projects that are still yet come to market, because I do think there's going to be a lot of support there for them.
This strategic competition in the world, the fragmentation of big economies, is clearly with us to stay. And that'll ebb and flow a little bit. So how can investors stay on top of this, Dale? How do you kind of translate these big geopolitical themes into actually actionable investment ideas?
In terms of, finding the individual ideas, it's kind of, that same process that we talked about earlier. It's spreading the net wide. In areas like mining, that management execution is really important. So looking for management teams that have, strong track records. You do need to think about the risks as well. So, things like permitting and that sort of thing. So really thinking about the jurisdiction as well. That's another risk factor that sort of comes into the equation. But I think there's definitely opportunities out there factoring in those different elements.
The policy changes and the geopolitical sort of directions can be viewed as a distraction sometimes for fundamental focused managers, especially the back and forth of it, and sometimes moving opposite direction within 24 hours. How do you navigate that? How do you know that something is a long-term structural allocation, structural opportunities, versus something that is more tactical?
I feel in this area, it's sort of one of those things where you step back and you look at the numbers. And there's, you talked about being reliant on one country for sort of 90% of supply. That's in rare earths, but there's other elements where, you've also got sort of significant portion of the supply chain in those markets. Just given everything that's happening geopolitically, you do get a sense that, you sort of have, I guess, a strong sort of backdrop of the general direction of policy. So that's sort of the backdrop, but it's not the main driver, as I've said. I think, having a sort of a good, supply demand balance outlook is definitely important. And then sort of the right regulatory regime with the right management team and the right project, I think is obviously really important as well.
Sam talked about the importance of having a whole value chain in place and bottlenecks across different parts of that. Dale, when you're investing, where are you sort of seeing or investing at the moment across that value chain? Is it upstream in miners, or is it more sort of downstream where there may be a little more visibility in things like demand or pricing?
Yeah, it's a combination. Probably the bigger bets are more downstream around processing. The areas where the supply chain is very clear, that the connection to customers is pretty much established. But everything is risk reward. So there's some upstream projects where the risk is higher, but obviously the potential rewards are really significant as well. And I think we do find some cases where I think sort of the risk reward is asymmetric. Again, as we sort of touched on earlier, these aren't going to be big bets given the risk that's involved, but they're worthy of some allocation as well.
Sitting in this part of the world, we've seen a very lively IPO market over the past 1 year plus. Do you continue to anticipate such, active market, and where do you see opportunities?
Yeah, everything I hear about the pipeline is that it continues to build. It's going to be a big year for robotics. You're probably going to see 2, maybe 3 of the big players come to market. I know we're hearing a lot about robotics now, but be prepared to hear more. So I think things are shaping up pretty well. As you know, we've seen the US listed ADRs listing in Hong Kong, but more and more of the Asia companies are listing in Hong Kong as well. So that's a sort of a pretty important component to the market as well.
Okay, that's all we have time for, unfortunately. I think that, while these opportunities obviously do provide very different challenges, what's standing out to me is that the investment process for assessing those has been consistent throughout. Obviously, we've had robotics where there's investing under uncertainty, small cap where we're looking to identify companies that can scale, and of course, rare earths where the opportunity is known, but geopolitics is clouding that picture. All three, I think, have this sort of common thread that on-the-ground research that is consistently filtered, challenged, and then translated into investment ideas that make it into the portfolio decisions is critical. And in an environment where there's just so much information and data available, that ability to really sort of convert insights into conviction is what's critical for generating returns for investors.
There's a lot of dimension through which we generate alpha. With robotics, it's about being early, have early conviction in an emerging, rapidly developing technology. With China small cap, it's about going deeper in the weeds for opportunities that are often overlooked by others. And in the case of rare earths, it's about being more geopolitical, taking a step back and looking at a global picture. So I thought it's truly mind-opening, the kind of variety of, ideas that we can potentially put into the portfolio.
Completely agree. And that simply leaves us to say thank you to Dale for joining us in the studio in Singapore, and to Teddy Gao, Reggie Pan, and Sam Hithersay for their investment stories.
You can find out more about what we discussed today from your local Fidelity website or from fidelityinternational.com. If you like today's episodes, please share and subscribe.
The producers today were Rory Fong, Patrick Graham, and Judy Chen, with technical support from Tommy Su and Keith Chuen. The managing editor is Seb Morton-Clark. From all of us at Fidelity, goodbye.
Goodbye.